What's up, everyone? It's Scotty with MoneyVest. So unemployment numbers just came out today. I'm going to break down exactly what those numbers were and how that essentially impacts the overall consensus for the markets moving forward, because I can tell you the numbers, as strong as what we just got, just lowers that probability for a potential rate cut going into next year. And the markets are certainly not liking that right now, with the pre-market NASDAQ, S&P, and the Dow Jones kind of rolling over a little bit. We're down about 30-40 basis points. Futures are down, but the yields are certainly pushing higher at the moment. So I hope you guys enjoy this video, find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. I would really appreciate that. And link to our Discord and Patreon is going to be down below if you're interested in joining. And of course, getting access to all the members-only private videos, including ad-free content, tutorials, lectures, intrinsic value spreadsheets, volatility spreadsheets, S&P 500 valuations, including trade alerts, and find out exactly what I'm buying and selling. So trade ideas, buy and sell alerts, options alerts, everything's going to be included. Definitely do check out the courses down below. Lifetime access to all the courses with all additional lectures and content will be uploaded over time. And you do get access to all the cheat sheets, Excel spreadsheets, PDF documents are also going to be included. And also do connect with me on Instagram. My handle is going to be CASWRP. Link's going to be down below for that as well. And I do post a lot of interesting stories, polls, portfolio updates, P&L, everything's going to be over there as well. So link's going to be down below for everything. So this right here is how the markets are doing pre-market. We've got the QQQs slightly down about 30 basis points, with S&P 500, in other words, SPY, which is slightly down about 10 basis points, and the Dow Jones here slightly pushing higher, or slightly down about 8 basis points as well. So market's not really reacting all that much, but the 10-year yields are definitely seeing a very nice bounce, up almost 2%. This is exactly what we talked about in our previous market updates, and something that I was expecting, considering how much we have seen the bond market move higher and the yields have continued to basically pull down, and we were obviously trading at very, very oversold levels. So a pushback higher or technical bounce from the bond market is not unusual, right? This is something that's very common. We're seeing a little bit of a technical rebound for the bond market. Now, this right here were the numbers. Job numbers coming in much better than what the expectations were, at close to almost 200,000 jobs added in the month of November. Unemployment rate ticks down from 3.9 to 3.7%. So that's where we are with the unemployment rate. And private payrolls also increasing about 150,000, and manufacturing payrolls was up 28,000. Participation rate slightly ticking higher to 62.8%, and average hourly earnings growing on a month-over-month basis. Year-over-year, it's up close to 4%, with average hourly work week here at 34.4 hours. But I really want you to focus on this 3.7% number, which has ticked down from 3.9. So this again continues to be an incredibly resilient labor market. Like, what is going on in the US? How are there so many jobs available, and how are there so many people employed given how high the rates are? I think it once again comes back to the idea that the private sector is very well capitalized, and there's been a huge transfer of wealth away from the public sector over to the private sector in the wake of the pandemic. And of course, as a result, a lot of these companies have not only great balance sheet, but are also generating a lot of cash flow, and a lot of the consumer spending is being fueled by a lot of credit card debt. And as a result, earnings and cash flows continue to be very strong to keep hiring at a very, very modest pace higher. And as a result, unemployment persons are only under 6.3 million. If you plug this number in to our spreadsheet, you'll notice that the ratio, which is job openings to unemployed persons ratio, is now sitting at under 1.4. Now, this number has come down from 2.5 to now 1.4. So we continue to see some weakness in the labor market, but it still continues to be incredibly, incredibly tight right now, considering how many job openings there are, and the very few, 6.3 million people that are currently unemployed relative to the job openings and relative to the overall participating population. This number is still really, really low. And that again goes to show that unemployment rate is only at 3.7%. If you scroll down, again, 3.711% is where we're at. So very strong economy. Like, I am just as surprised as you are. It continues to be very resilient. If you take a look at the probability outcomes here for the markets going into next year, now we have pushed forward the rate cut to May. Earlier, this one was at March. So if you were to have looked at this number yesterday, markets were pricing in rate cuts beginning in March 2024. And now the markets are pricing in May 2024, all the way through December 2024. Basically, still 5 rate cuts priced in. So 1, 2, 3, 4, 5. So 5 rate cuts are priced in from the market. And that's really where we are at the moment. So still 5 rate cuts, but it's been pushed forward by just about 2 months. Earlier it was March, now it's May. And of course, the next Fed meeting is going to be in 5 days. So next week, we've got the FOMC meeting. I will be live to, of course, cover that entire meeting and everything that Jerome Powell has to say. So that is going to be very, very important, of course. And we're going to listen in to everything that he has to say about the market. So going over to the technicals. Now, this is both a good news and a bad news in a way that it's good news that the economy continues to be very strong. The labor market's very tight. It's resilient, and there is a possibility for a soft landing because inflation's coming down and unemployment stays low. So that is, once again, kind of refueling the narrative of a soft landing. But that, once again, kind of encourages the Fed to keep raising interest rates or keep them higher for longer, kind of dismisses that rate cut sort of narrative, because if the economy is strong, the economy can handle it, right? And that's really what the whole sort of thesis is from Jerome Powell and the Fed, is that we haven't really seen a lot of weakness in the employment numbers, and thus the economy continues to be resilient, so we can hence keep rates higher for longer in hopes of bringing inflation down while also the economy being super strong. So it's really kind of like, you know, we gotta be careful what we wish for, because if you do expect the economy to be strong, then on the other hand, we can also expect for Federal Reserve and Jerome Powell to not cut rates and keep them higher for longer. However, if we are expecting rate cuts in 2024, to couple with that, we also need to expect some type of weakness in the labor market and some type of recession, because rate cuts only happen on the back of recession or deflation, right? The Federal Reserve is not going to cut rates just because they feel like it. They need to fix something. They need an incentive to cut rates, and right now, they don't have any, because the economy is strong. We just got the unemployment numbers. Inflation is coming down, but it's not down to their target, or nonetheless, we're not even in deflation yet. So they need a reason, and that reason is not here yet. So next year, we're going to find out whether the Federal Reserve cuts rates or not. But next week, of course, we got the SEP Summary of Economic Projections. And of course, we've got Jerome Powell's speech, which I'll also break down as well. So with respect to the yields, we're seeing a little bit of a pushback higher. So don't be surprised if this actually ends up being a little bit of a sort of like a negative catalyst for the market, because it's part of the trouble trifecta, as we like to call it, the dollar index being one of them. And it's already starting to move back higher. So from lows of 102.5, it's pushed up 1.5%. Crude oil prices is another, which obviously has been selling off quite aggressively, although pushing up over 1.8, almost 2% on the day today. And of course, not to mention the 10-year yields are also on the move higher, pushing up from lows of about 4.1%. Have already moved up about 13, 14 basis points, a little bit higher than 3% on the last couple of days. So it's possible that markets do see a bit of a pullback considering how overextended, overbought we are. But I only expect that to be about 2 to 3%, maybe 4%. And December seasonality to play a much bigger role. But going into January of 2024 and going into next year, again, it's going to be a little bit of uncertainty related to the time lags, interest rates, inflation, economic growth, unemployment. So the whole macro picture still looks pretty uncertain considering where we are with everything, with rates and inflation. So hope you all enjoyed this video and a quick update on these numbers. Make sure that you do check out the links down below for our Instagram. Ticker handle is going to be CASWRP. All the courses, lifetime access included, and also do check out our Patreon and Discord if you want to join, be a part of our Money Invest community. You get access to all the members only ad-free content, Excel spreadsheets with intrinsic values and my watch list and my buy targets, and of course Discord channels including trade alerts and trade ideas as well. And as always, happy investing, and I'll see you all in the next video.